Hi, I'm Tom Mihawk, and welcome to my personal finance course. This chapter is called Financial Statements and Budgeting. Now, I was going to change the name. I was going to call this something like Personal Money Management or Record Keeping or something like that, because this is not really yet about, where to put your money or what kind of accounts or anything. This is about what you do with your money every day. Where do you spend it? How do you track it? How do you know if you're doing well or doing poorly? How do you develop a plan to have money at the end of the month, end of the week, something like that? Well, this chapter will help you begin to figure that out. So, personal money management is the center of your financial planning. This is about the daily decisions you make to do with what to do with your money. Save, spend, or invest. You need regular activities to work toward financial security and achieving your highest financial state. It's like working out, right? Going to the gym. You learn all the time that it's not so much how much you lift, although that matters, but it's that you go regularly. It's that certainly you increase your load, increase your work, but it's a matter of being consistent. And the same thing's true with personal money management. You have to be consistent. You have to have some tools. You have to do better the next time than you did last time, and do it on a regular basis. You make these decisions considering your goals, your personal situation, your needs, the economic environment you're in, the time you have, and your resources. All these things impact your personal money management. Some steps. The personal financial records you have are the foundation of an organized financial life. They provide written or electronic evidence of financial operations, meaning your spending, your saving, your earnings. Financial operation sounds corporate, but it applies in a home too. Your ownership and the discharge of debt and legal issues. Use those records to construct financial statements that allow you to determine your financial position and progress toward your goals. Use these tools we're going to learn about in the second segment of this chapter: the personal cash flow statement, the balance sheet, and the budget. A spending plan or a budget is the basis for effective money management. So where do you keep your financial records? I keep them in files. I have written files. I have a computer that I keep them on in the cloud. You'll do the same. Sorry for all the text on this slide, but there's just a lot of information. So a safe deposit box, likely at your bank, or a fireproof home safe is the place to keep hard copies of information that's difficult to replace. These things would be things like birth certificates, marriage and death certificates, copies of your will, although keep that elsewhere too. Many law firms offer to do this, so it's out of a home that may burn, away from a bank. If you die prematurely, might your safe deposit box be sealed until someone with the right authorization can open it? So, don't only keep it in your safe deposit box at your bank. Excuse me. Citizenship papers, military, adoption papers, custody documents, lists of your insurance policies and your investment accounts, photographs of your valuables. We'll talk more about that in the chapters in which we talk about homeowners insurance, but it's key to have photographs of valuable things. You don't always remember what they are. You don't remember the serial numbers or exactly which model or exactly what features it has. So photographs are really beneficial. Mortgage and title documentation. Important original receipts that you may have to show later to evidence to maybe get the benefit of a warranty. Rare personal items like coins, stamps, and possibly art. I closed a safe deposit box within the last maybe 3-4 years, and there was a jar, a clear jar of coins in it that was from coins from my parents, coins from my brother-in-law, from their various travels, all foreign denominated currency. Now, that's safe deposit box or fireproof home safe. In your home file, computer, or certainly these days, cloud storage, records for your taxes, money management records, your personal and employment records, financial services, credit records, purchases, warranties, insurance, housing, investment, and your estate planning documents can be on a home file, computer, or in the cloud. Back those up, right? Back those up. So, records, storing and throwing away. Keep indefinitely things like birth and marriage records, Social Security documentation and cards, the purchase and sale of real estate information, religious documentation you may need to show later, like baptism certificates or confirmation or something like that that you'll need to show later in life. Keep 7 years copies of your tax returns and supporting documentation. The IRS has 3 years to do an audit, but there are some circumstances in which they can go back and double check. So authorities say 7 years is the right amount of time to keep your tax returns and supporting documentation. As long as you own the items, keep the records for your home, auto, property, and investments. Throw away receipts for small, non-deductible purchases, expired warranties. Now, the thing is, this requires some administration. You have to go through these records from time to time, and that's a challenge too. You know, I hate to say it, but I have tax records back from before I was married, like right when I was out of college, and I probably should discard them, but I have room in my attic for the moment, and every once in a while I've gone back and looked to see what my income was in those days. So, but in terms of the advice I'd like to give you, 7 years, get rid of it. Shred non-annual investment documents, meaning quarterly, monthly, half year. Keep the annuals, but throw away the quarterlies, shred them rather, the quarterlies and the monthlies. Documents with personally identifiable information, like Social Security numbers, account numbers, maybe medical information that you no longer need. And send to your computer recycle bin. Empty it regularly and completely erase your personal information files from your computer recycle bin. So send things there regularly, but then empty it and erase completely your personal information there. Now let's talk about some basic terms, because we're going to start to introduce really important statements or models, the balance sheet, the personal cash flow, the budget, and some basic terminology is important to know before we get there. So liquidity is the capacity of an asset to be turned into cash. Very liquid examples, things like cash, bills, and coins, right? They're completely liquid. You hand someone a green paper United States dollar, they take it for purchase and give you change back. It's completely liquid. Moderately liquid, like investments. When you have investments at Vanguard, Fidelity, and you want to, for example, and you want to liquidate them, you can get your money back in the form of cash fairly quickly, a few days, maybe sooner, depending on how your accounts are registered. If they have to be done by mail, a little bit longer, but that's moderately liquid. Illiquid things are assets like your home. It takes time to sell, and a fast sale, while it can be done, a fast sale was going to result in less than fair value. So a home is a great example of an illiquid item. Another relatively illiquid item might be a car. You can sell a car in a few weeks, depending on maybe what kind of car it is. Maybe longer if it's very expensive or something like that. It's less liquid than a home. Your home is among the examples of things that are illiquid. Liquidity is important. You can't pay your bills if you have no liquidity. If you have high net worth and everything's illiquid and you can't pay your power bill, your cable bill, buy food, that's a problem. Opportunity costs. Spending today reduces what you can save and invest. Now, we introduced the concept of opportunity costs in the first chapter, or the second, I think the first. But as it pertains to personal money management, spending, and budgeting, spending today reduces what you can save and invest. Focusing on the future solely reduces your personal consumption today. So if you're focused on the future, you don't have much money to spend today. Buying on credit increases the costs of goods because it adds interest cost to borrow. Using savings for purchases, however, depletes your savings and reduces what you can invest and reduces interest. Reduces the interest cost, but reduces your savings and it reduces what you can invest. And lastly, comparison shopping to save money takes time. So comparison shopping is a great thing, right? But it takes time to do. Okay, income. Income is what you earn through your job. It's interest from bonds and dividends from stocks. It's earned from assets, not through your job, like real estate rents, loans to others, licensing, those kinds of things. And income is generally measured over a period of time, like a year, a month, 3 months, which is a quarter, that kind of thing. If you're a student, a semester, right? So over a period of time. Expenses are what you spend. Examples are food, rent, mortgage payments, cable bill, entertainment. It's measured also over a period of time, 1 year, 1 month, 1 year, 1 semester, that sort of thing. So these are going to be the primary components of your personal cash flow statement. In the corporate world, we call this an income statement. In the personal finance world, we call this a personal cash flow. Income and expenses, it's what comes in, inflows, what goes out, outflows over a period of time. Along the same lines, assets are things you own. Assets can generate income, they can grow in value. An asset that you own would be, for example, a bond, could generate income. It's measured at a moment in time, a point in time. Example, December 31st, September 30th. Examples are cash, bank account balances, investments, stocks, for example, a car or a home. Liabilities, on the contrarily, are what you owe. Their liabilities can generate expenses. So a liability might be a school loan, and it has a monthly payment. It could be a home mortgage. That's the liability. The expense is the monthly payment. These are measured at an instant in time, just like assets. December 31st, September 30th. Example, school loan balances, car loan balances, home mortgage amount. So of the two things we have personal cash flow items, income, and expenses. This is what comes in, what goes out, measured over a period of time. And then personal balance sheet items, what you own and what you owe, measured at a point in time, not a flow, but at a point in time. What you own and what you owe. And both of those, what you own can generate income, an inflow, and what you owe can generate an outflow, an expense, but what you own and what you owe are on your personal balance sheet. This is the first segment of the chapter on financial statements and budgeting. Please come back for the second. See you in a minute.